Okay, today we're looking at options in banking, and a bank is a financial institution that acts as a payment agent for customers by conducting current accounts, paying checks or debits drawn on the accounts, and collecting checks or debits. A bank offers various savings options, and it borrows and lends money. Commercial banks are regulated and require a bank license to operate, so not just anyone can decide to have a bank. Banks in the United States provide almost all payment services, and a bank account is considered indispensable by most businesses, individuals, and governments. Channels to access banking services, in other words, how you can get these services, would be to go to your local bank branch, to use an ATM machine. You can send things through regular mail. You can do telephone banking, where you go through the automated message, and online banking. Online banking or internet banking allows customers to conduct financial transactions on a secure website. This allows customers to conduct their bank business online, including bill payment, money transfers, investment sales and purchases, loan payments, and viewing bank account records. What are some of the benefits of keeping money in a banking institution as opposed to just carrying cash? And an example is that it's not as likely to get stolen. You have records of your transactions, and sometimes you manage your money a little bit better, and it's easy to access your funds. All right, going to the next page. Bank loans. Acting as a provider of loans is one of the principal tasks for a bank. A bank loan is a type of debt. The borrower receives an amount of money from the bank or the lender, which they pay back in regular installments to the bank or the lender. This service is generally provided at a cost, and that cost is referred to as interest on the debt. So when you borrow money from a bank, you're going to give the money you borrowed back, and you're also going to give interest. There are two types of loans possible. The first is a secured loan, and you're going to have collateral used to back the loan, such as the lien on the title to a house until the mortgage is paid in full. Your collateral is something that if for some reason you don't pay the debt back, they can go take your collateral, sell it, and get some money. And then you have unsecured loans, and no borrower's asset is used to secure the loan. This is going to be things like credit cards, bank overdrafts, personal loans. One type of loan is based on simple interest. And the formula for simple interest is equal to principal times rate times time. Your maturity value, or the overall amount that you're going to end up paying back, is your principal plus your interest. So this right here is going to be pretty important. You need to keep that handy to look at. So for example, we have a loan for $4,500, and it's taken out for 2 years at simple interest, 8.75%. Calculate the total interest for the period of the loan. So based on our formula, the interest is going to be the principal, which is the amount you borrowed, so $4,500, times the rate, which was 8.75%. You need to make that a decimal, so 0.0875, times the time, which is the number of years, which was 2. So you would take your calculator, and you would say 4,500 times 0.0875 times 2. And you're going to get $787.50. So there's your answer. So then you want to calculate the maturity value, and that's going to be your principal, what you borrowed, $4,500, plus your interest, $787.50. So if you take your calculator and you say 4,500 plus 787.50, and you get 5287.50. Some loans are paid in full at the end of the loan period. Most loans, however, require that the borrower pay off the loan in regular installments, like every month, every 6 months, something. So if the loan above were to be paid off monthly, what would the loan payment per month be? You would take the loan, actually the maturity value, because it's the loan and the interest, and you would divide that by 24, because there are 24 months in 2 years. So you would have a monthly payment of $220.31. Final payment would be $220.37, and the reason it's a little bit different is that it just doesn't divide equally. All right, going to the next page. If you borrow $1,250 for tuition and books on a short-term bank note, it will be due in 6 months, and it is at a simple interest rate of 7.25%. You're going to take your $1,250. You're going to multiply it by your 0.0725, and it was 1 year. So you're going to get an amount, and then you're going to have to divide by 2 because it's due in 6 months, which is half of a year. So you would say $1,250 times 0.0725 times your 1. You would take that and you would divide it by 2. And so you have $4,531. How much will he owe at the end of the 6-month period? So you're going to have to say, I borrowed $1,250 plus we have $4,531 interest. And so when you add those, you should get $1,295.31. All right, to complete the table, $10,000 is borrowed at 6.75% simple interest. So for your interest, you're going to do, remember, your $10,000 times your interest, 0.0675, times your time, T. So for the first one, it would be times 1. So it would be 675. If it was 2 years, you would change that 1 to a 2 and you'd get 1350. If it was 3 years, you would change that to a 3 and you would get 2025. 4 years, it would be 2700. 5 years is 3375. So basically turning that into a formula, it's 10,000 times 0.0675x, or if you want to go ahead and multiply those two, it's 675x. The maturity value is the 10,000 that we borrowed plus the interest. So 10,000 plus whatever your interest was that you had just found. So 10,000 plus 675 would be 10,675. 10,000 plus 1350 would be 11,350. 10,000 plus 2025 would be 12,025, etc. So your formula here is 675x plus 10,000. Your monthly payment would be the maturity, sorry about that, would be the maturity divided by the number of months. So like on this first one, you would divide it by 12. On the second one, you would divide by 24, divide by 36, divide by 48, divide by 60. Eventually, I will get us where we want to be, sorry. So your formula here is 675x plus 10,000 all over 12x. Okay, so construct a scatter plot. That just means plot your points. What function rule? We've already found that, 675x. Is it a direct variation? Remember, to be a direct variation, it has to go through the origin. If you look at the graph, it does, and so yes. Okay, yes, it does. It goes through the origin. What does the slope represent? What is that? What is your slope? Well, it's the number with x, 675, and that is how much the interest is going up each year. It's the rate of change. So then a graph for your maturity value would look something like this. Your equation we have on our table, 675x plus 10,000. Is it a direct variation? And it is not, because it does not go through the origin. So your answer here is no, it does not go through the origin. What does the y-intercept represent? Remember, we've talked about this before in previous classes. Y-intercept is the starting point. In this situation, it's how much you borrowed. So it's 10,000, it's the principal or the amount borrowed, whichever one you want to call it. What does the slope represent? Once again, your slope is how much the interest is going up each year. Scatter plot for your last function would look something like this. The equation is like this. What is the parent function? I would take a couple of different answers. They're going to say inverse. I would also take rational, because we've studied that rational functions have an x in the denominator. Is it increasing or decreasing? Notice the line is going down, And so the answer there is going to be decreasing. And then we're not going to worry about comparing. All right, next page. That's all of your notes. You're ready for your assignment. If you have any questions, call me over.